AM Best will host a pair of upcoming virtual conferences focused specifically on Canada's insurance market. The first will take place on September 9th and sort through the sector's recent performance in the wake of catastrophes and COVID-19, in addition to the difficulties posed by the prolonged low interest rate environment. I'm John Weber for AM Best TV, and I'm joined today by two analysts who helped author an upcoming report on this market, Brian Lynch and Anthony McSwieney. And Brian, we're going to start with you today. How would you characterize the performance of Canada's property casualty sector for 2019 into 2020?
Canadian PC insurers fared very well through 2019, despite growing challenges. Underwriting over the average was break even. That being said, premiums are up 10% through rate, which is going to be helpful for those PC insurers in the future and is a positive sign. Auto lines, especially personal lines, were particularly volatile this year. We're seeing that because of some inflationary costs as well as increased expenses that are affecting the severity of each claim. Commercial and personal property lines fared very well this year, and this is largely because of a calmer cat year compared to 2018. The true profit line of this year was really investment performance for Canadian insurers. They increased their asset base by 6% this year and performed very well over the course of the 4 quarters.
What are some of the key challenges on the property casualty side that AM Best will be monitoring, Brian, as we head into the 4th quarter of 2020?
I wanted to start by saying that PC insurers in Canada were well positioned through 2020, and they proved that through their COVID stress testing that we performed in the 1st quarter and in the first phase of the quarantine. AM Best took no negative rating action on any PC Canadian insurer. And that's a testament to their solid capitalization as well as their risk mitigation practices. That being said, COVID-19 and the new normal that's become of it is changing the lives of insureds and is creating a slew of new benefits as well as new challenges for insurance companies. Those new benefits relate to the remote work, whether it be the decline of ridership from remote workers, and also the hypervigilance that comes with being home now more than ever. People are identifying flood risks, water damages, fire hazards much earlier than they ever have before. And this is, in the long run, decreasing the severity of each claim, which is really great for the industry. But on the flip side of that, we've got new challenges like, how will these remote workers be covered in the future? What kind of cyber exposure has been exposed because of the rush to work from home? And finally, how do insurers provide that same high quality level of care, distribution, and service that they've been providing for years, now that the traditional methods have kind of become unavailable to us? And that being said, COVID-19 may have taken the spotlight, but we still have to worry about climate impacts, and insurers are still constantly concerned about that. The Calgary hailstorm in June was the 4th largest cat in Canadian history, and there's significant evidence there that climate impact is a contributing factor. So in the future, we'll be keeping a close eye on insurers' risk mitigation practices as well as their innovative thinking towards distribution and data utilization.
Hi, Anthony. AM Best changed its outlook for Canada's life annuity segment to negative in April, citing the disruption to the financial markets following COVID-19. What's changed since then?
John, so not much has changed since we revised our outlook in April from stable to negative. Just to get a little bit of foundation, the Canadian industry came off a good year in 2019. They started the 1st quarter in 2020 strong. We did change our outlook, in April as a result of the financial crisis created by the pandemic, by COVID-19. And the fundamentals essentially have not changed. What has changed is we've kind of matured into the crisis. So there's more known variables that we have right now that we didn't have when we revised our outlook. The outlook is still negative, We won't be changing that. But the first order of impacts that we were concerned about when the outlook changed came to fruition, right? Those were things related to the volatility in the equity markets, the lowering of the interest rates, and the implications of that had the immediate impact in the first quarter P&L for Canadian insurers, particularly around derivative losses tied to expiring or near expiring hedging activity, which are permanent losses for insurers. Now, that doesn't move the needle from a ratings perspective, but it created that volatility in the P&L that we had anticipated. And that's why we essentially changed the outlook, because we knew we were going to run into a period of volatility on the earnings side and the balance sheet side. So now that we're sitting here in the beginning of September, what has changed or what's new? Our initial thoughts were realized. The equity markets did rebound. We do have low interest rates right now. And those factors, even though the equity markets have rebounded, we still are going to have volatility in the market. And that impacts more than just equity market pricing. It impacts cost of hedging. It impacts insurers' ability to model their expected profitability on their liability book. So at some point, when we look at, for example, the low interest rate environment, if we do continue to stay at these low rates, insurers will most likely have to revisit their assumption changes related to the profitability of the liability products, which means that there could be modeling assumption changes relating to product liabilities that could create a little bit of volatility in the future related to the P&L. So we're not out of the woods on that yet.
Now, the report also notes the potential for credit impairments with respect to the investment side. So, Anthony, how has that played out since April?
So that's been a little interesting. When we first changed our outlook in April, we did not anticipate the federal governments around the world supporting the economies. The actions that the U.S. took related to aid to businesses, that was not part of our calculus when we changed the outlook. So what does that mean now that we're 4 months into this situation? What does that do to our calculus related to our outlook? It really doesn't change it. I think, John, what it does is it really changes the timing and the potential impairments, right? Because this is a credit and impairment issue that we were concerned about when we revised our outlook, and that still exists today. That does not change. When you look at sectors like the hospitality, the travel industry, the airline industry, the government supported those businesses. So the anticipated timing of credit impairments that we thought would occur maybe within 4, 5, 6 months are likely to be pushed out almost 12 to 18 months. So we would anticipate maybe in the fourth quarter of this year to begin to see maybe impairments that we would have expected earlier on. Insurers also have been very proactive in restructuring their loans. For example, if you look at retail loans went from principal and interest to interest only. So companies that have liquidity, I'm not talking about insurers here, I'm talking about borrowers. The ones that have liquidity can afford interest only payments and sustain their business model through these hard times where they can't get the restaurants packed, they can't get people in the hotel rooms, they can't put people on airplanes. It's buying them time, but it all comes down to credit strength in a prolonged financial crisis. If the companies don't have the balance sheets, they're still not likely to weather the storm long run. So the impairments, John, are still an issue. We haven't changed our view on the credit impairments. It just pushes it further out down the road, which actually could be a little bit of a tailwind for insurers. And the reason why I say that is the Canadian insurance industry has a very strong regulatory framework. So they came into this crisis with a very strong balance sheet, or strong balance sheets, plural, and strong P&Ls. So this provides a very good, maybe I'm going to call it a hard landing for the purpose of this interview, where if things come in stages, the first order impacts hitting the P&L that we talked about, equity markets, interest rates, they can absorb that through their P&L, which is a good thing. Credit impairments, if it comes later, that's the second order of impact, that will get absorbed both by the P&L and the balance sheet. Both those things are very strong for Canadian insurers. So, why we have a negative outlook, we don't necessarily anticipate rating changes as a result of this.
Thanks, Anthony. Thanks, Brian.
John, thank you for having us.
Thanks, John.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.